In this video we are going to talk about the dividend snowball. So before starting, please like this video and subscribe to this channel for our future updates. If you have the patience to wait, dividend snowball investing can help you compound your way to enough income to cover your bills and eventually become financially independent. Have any of your childhood memories include rolling a snowball on the ground to create a snowman or woman? With each roll, the snowball accumulated a little more snow, resulting in it becoming larger and larger. When you invest in dividend snowball investing, each dividend reinvestment increases the size of your future dividend payments, in the same way that stock market trading does. If you're seeking to build a dividend portfolio to generate monthly income, this growth technique will assist you in getting there with patience and time on your side. How dividend snowball investing works. The debt snowball approach developed by David Ramsey serves as the foundation for dividend snowball investment. When you use a debt snowball strategy, you pay off your smallest debt obligations first, then apply the funds to your next debt obligation. The fact that your minimum payments are being spread across fewer accounts means that you'll be able to pay off debt more quickly because you'll be reducing the number of balances you have to pay. Dividend snowball investing, while unique, is based on the compounding effect of reinvesting dividends back into the same investment to increase future dividend payments and increase the size of future dividend payments. With each reinvestment, the value of your shares increases a little bit. Your next dividend payment will be slightly greater as a result of the addition of a few additional shares. When a sufficient amount of time is invested in sound businesses, the growth effect is amazing. If you do not reinvest your dividends or increase the number of investment shares in any other way, the only way for your payments to increase is for the corporations to increase the dividend rate per share they pay to you. In the vast majority of cases, corporations will increase dividend rates on an annual basis. Each year, if you possess 20 Coca-Cola Company (KO) shares and choose to receive the dividend rather than reinvest it, you will earn a little greater dividend payment than if you reinvest the dividend. As a result of reinvesting your dividends into partial shares of KO, each payout grows slightly faster as you accumulate more shares, while also receiving a bigger per share income. A stock split or even a merger that results in the creation of new shares would be the only other option outside purchasing additional shares to increase your holdings. A company's equity is split in half, and the dividend is split in half as well. Ownership and dividend distributions will both rise in the long run, but neither of these events will occur very frequently in the short term. Deciding to reinvest your dividends or not in your dividend snowball. In order for the dividend avalanche to rise at a quicker rate, additional shares must be issued or purchased in addition to annual payout increases. Using automated reinvestment versus manually purchasing shares. When it comes to dividends, there are strong viewpoints among those who do their own investing on whether they should be automatically reinvested or just paid out in cash. Some people like to keep an eye on the stock price in order to find the best deal possible, and this is something that some people do. It is possible to make a better investment in a different location than where you are currently. Keep in mind, however, that if you choose to make manual purchases rather than allowing your money to be automatically reinvested, you may be required to pay a trading commission to the broker in exchange for doing so. Also probable is that you will be required to have sufficient funds to purchase an entire share rather than a half ownership in order to participate. When used in conjunction with automatic reinvestment of dividends, the snowball strategy allows you to accumulate a collection of partial shares over time, which you can then utilize to further grow your portfolio as your funds allow. Make sure you calculate how many shares you may receive. Investing dividends in partial shares sounds fantastic, until you realize that you're only getting a 0.001 share of stock in exchange for your investment, which isn't very much. Until a single Individual owns the entire corporation, it will take decades for them to do so. In a similar vein, if you need to transfer your investments across brokerage firms, any partial shares will be sold because brokerage firms only transfer full shares, not fractional shares, and so cannot transfer fractional shares. Not only does this put you back in the same position as when you first obtained the investment, but it also means you have additional documentation to deal with in preparation for the next tax year, which is a hassle to deal with in the first place. Calculate the number of shares you'll need to purchase in order to earn a minimum of 1/4 of a share every year for each company in which you're considering investing, using a 2-cent per share valuation as a starting point for your calculations. Because of price variations, it is conceivable that the conclusion will not be exactly as predicted. Nonetheless, it will be close enough to aid you in making a decision. After reviewing the dividend yield of the company, it is conceivable that you will be startled by the amount of money you will need to invest in the firm when you see the final figure. If you are just starting out, start with what you have and gradually build up your holdings if you have more money and believe the stock's value will rise in the not-too-distant future. Make sure you purchase a stock with a history of paying dividends. If you want to be successful with a buy-and-hold dividend snowball approach, you need to invest in shares of strong firms that have a long history of paying and increasing dividends over time. The dividend snowball approach is what this is referred to as in the industry. While previous success does not guarantee future outcomes, companies such as the Dividend Kings, which have been in operation for more than 50 years, are considered safer investments because of their long track record of dividend payments. The stock market is a particularly challenging environment in which to make the best judgment possible given the facts available at the time of the decision. And don't forget about income taxes. An additional difficulty that we were not aware of when we initially began investing was the fact that we would be obligated to pay taxes on our dividends. Dividend income, which includes dividends reinvested in non-retirement funds, must be reported and taxed as ordinary income. In addition, interest income is subject to income taxation. Contact your preferred tax professional or tax preparation software for more information on determining how much tax you will owe and how much tax you will save. Avoid being caught off guard like you were last year when it comes to filing your taxes. Furthermore, you should pay close attention to the types of firms in which you put your money. In contrast to an ordinary dividend, a qualified dividend is subject to a lower tax rate than an ordinary dividend. Qualified dividends are created by specific corporations and are taxed at a lower rate than ordinary dividends because of the reduced tax rate. The shares you receive as a qualified dividend are usually issued by blue-chip companies, and there are restrictions on how long you may hold on to them after receiving them. A common occurrence is the payment of ordinary dividends by real estate investment trust, REIT, enterprises, or by shares that have not been held for a sufficiently extended period of time. Keep in mind that investing in one type of stock as opposed to another is not an indication of a bad investment decision. You want to be sure that your purchasing decisions are based on solid information before making them. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.